I'm joined by Robin Marshall. He's a director at Smith Williamson Investment Management, specialises in the international fixed income market. Great to have you with us. Thanks so much for coming in.
Pleasure.
So if just taking a look at the results of that bond auction there, demand was good.
Yes.
Don't yet know what they paid for it, though, but if recent developments in the bond markets are anything to go by, borrowing costs will be high.
Yes, and we don't know exactly who bought it as well, so it'd be interesting to see what the balance is between the domestic buyers and overseas. But Spain actually is not at the moment really in the firing line. I mean, there's been some contagion, limited. Clearly, it's more, the market is very much more focused on the likely Greek restructuring, how that plays out, and then Ireland and Portugal. Spain is in this middle group with Italy, which at the moment is largely off the radar screen as far as the restructuring goes.
Do you think it'll stay that way if restructuring talk continues, given Spain's exposure to Greece and
Yes, I think size
Portugal
matters with Spain, and clearly the exposures of the EU banking system are substantially greater again to Spain than they would be to Greece, Ireland, Portugal. You know, you're talking trillion plus exposure to Spain as opposed to, say, 150 to Greece, total EU banking exposure. So much more modest to Greece, Ireland, Portugal than Spain. So Spain, I think, will be saved. There's a fault line there. There will be an enormous defence of Spain if it comes to it. And actually, they may well get through it. The more interesting issue is for the markets for now is how they solve Greece, Ireland, and Portugal.
Now, you're saying that you said the market is very much focused on Greece at the moment, and you think the likely outcome is that the maturities will be extended on Greek debts,
well,
right?
I think they've got to do this in a way that minimises damage immediately to the EU banks and the dangers of having to recapitalise them yet again. So some sort of voluntary, in inverted commas, rescheduling, where they extend maturities, cut coupons, is the likely outturn. And then
what would that mean for the banks in Europe?
Well, then they can present that. They can, in the stress test, they'll probably mark that stuff to 100 and say, well, we haven't wiped out all the tier one capital of the bank, so we can get away with that. It's a bit of an accounting wheeze, but
it's still costly.
Yes, but it's, on the other hand, it's a much lower cost solution than doing the cathartic one, doing a Lehman's type thing, saying it's a 50% haircut, how you left. And that would, of course, could unleash some severe problems in the financial system. So, and the EU just doesn't do catharsis like that.
Just to be clear, under this scenario that you're outlining, would the smaller banks in Europe have to take losses?
Well, I think the idea would be no one would have to take immediate losses because they would be able to put this, they'll say, our holdings can still be marked to market at 100 because eventually this stuff will repay at 100 even if it's 10 years further down the road. So in a way it's an appealing solution. It doesn't resolve it forever, but it's probably the first step. And it's a done deal, I think, now that there'll be some sort of rescheduling, and this to me is politically the most attractive first step.
What does that mean for the risk of contagion? Because I know you've been saying that, okay, markets have been making a clear distinction between Spain and Italy and then those smaller, more vulnerable countries. But in recent days, we're seeing borrowing costs inching up on this talk of Greek restructuring. So is it only a matter of time before concerns resurface with regards to Spain?
Yeah, I think Spain, for the time being, is okay. There clearly is a risk in property, in the Cajas, whether they can consolidate these regional banks, these mutuals, what the bad loan losses will be. The problem is that if you condemn these economies to ongoing deflation and recession through austerity programs, you may make the problems worse. So it strikes me that some sort of solution for Greece, Ireland and Portugal may actually not be a bad outcome in the end for Spain. The longer this uncertainty plays out, because we know they're going to have to be reschedulings, I think, in Greece, definitely, and then probably Ireland and Portugal, it strikes me that isn't helping Ireland, Italy and Spain if you're just dragging out the uncertainty and allowing the contagion to continue.
And when you speak about uncertainty, it makes me think of the recent election in Finland. We're seeing increasing domestic pressure from those economies in Europe that are stronger when it comes to bailing out other countries. I mean, how is that going to be resolved?
Oh, you're quite right. I mean, this isn't easy. This is all about second bests, and this is about EU fudges, and this is going to play out over years, not months. But it strikes me that some form of resolution to Greece is almost inevitable. They cannot go on like this with 20% yields in a huge debt trap. But you know, you're quite right. In the end, you could argue the thing will either split or we'll get closer fiscal union with the ones that stay. And I think that's probably, you can't have, the current situation is not a steady state.